Welcome back to Bunnex Investment Group. In this video, we'll talk about a small account trading strategy. If it was not for the prop firms that we have right now, like FTMO, Funded Next, Blue Guardian, to name but a few, that came with bigger accounts, most people could be trading on small accounts. I've seen a lot of people now can trade bigger accounts, 50, 100,000, 200, and I myself actually trades a total of 1.1 million. However, we still have traders who love to trade their own personal capital, no matter the size. Someone can actually deposit 200, 300, 500, even $1,000 in their trading account, and that's still fine. So this might not be enough to cater for the day-to-day bills, because we are saying if you plan to get approximately 5% per month on $100,000 account, you will be actually earning around $50, which is not enough even to pay for an internet bill. In this video, we will review a strategy that uses the M15 time frame and is suitable for growing a small trading account. We'll review this exact point of market entry as well as exit. Before we talk much about this, please check out our free ebook. I'll leave the link in the description box below. It will enlighten you on becoming a 7-figure trader. All right, on with our info, the market structure. The trading information around defines the market structure as a floor with higher highs and higher lows or vice versa. However, it fails to input the right parameters that removes subjectivity within this narrative. We'll trade the market structure, but we'll incorporate some EMAs to view the markets. Here is the setup that we'll follow. Basically, we are following a 3-move setup, or basically a small micro market maker cycle, whereby we are saying we need to see the first impulse and the second impulse. If these two have been noted, whereby the second clearly cuts above the first, we will actually wait or prepare to get an entry. So we are saying the second M15 impulse must have a 250 EMA cross. We are saying when this occurs, when we have these two, we should see a 50-200 EMA cross. Then our entry will be made at the 50 EMA, provided the second impulse broke structure. Here's the entry trigger. When the market retests the 50 EMA after the conditions above have been met, we need to see a proper candlestick reversal pattern. These includes a hammer, a doji, a bullish engulfing pattern, or even a railroad track. Stop loss will be below structure and take profit at 1.5 R. Before we move forward to the chart examples, we have an upcoming program which is becoming a 7-figure traders program. In this particular program, we will be actually giving you 3 live sessions of market analysis each and every week. You actually get access to the Becoming a 7-Figure Trader program course. You also be able to be in a trading flow where you meet like-minded traders. Make sure to be part of this program. It's going to enlighten a lot of people. I'll leave the link in the description box below. Let's now have examples on the charts. So this is USD against Canadian dollar. We are going to look for the points that we've said. We said we need to see at least a 50 EMA crossover within the level 1 or level 2 or impulse 1 and impulse 2. So I'm removing all other indicators so that we can see clearly. We can see that we had the first rise to the upside and the market broke structure at this particular point. Within 1 and 2, there was a 50-200 EMA cross to the upside like that. Therefore, our entry was going to be at the retest of the 50 EMA, which is at this particular point. There was a bullish engulfing pattern that was here, our stop loss below structure, and our take profit at 1.5R. That is 1.5 multiplied by the number of pips that you have put on your stop loss. Then we move again forward. We can see there was a crossover of the 5200 EMA. And within that crossover, we had the first drop to the downside. We had another drop to the downside that actually broke the low of the first impulse. First impulse low was broken at this particular point. Then we can see the market came back to the 50 EMA. At the 50 EMA, it slashed to the upside and gave us this huge impulse to the downside, which is this one. But whenever we see a spike or fast moving candle like this, we actually expect to see a retracement to 50% of that particular candlestick. So at 50% of this particular candlestick, that is where we're going to make our entry and our stop loss at above structure and our target at 1.5 R, like that. So in this particular case, we have this case whereby we had an impulse to the upside. Then that impulse actually did not break. We can see this was actually the move. The market did not break above the high of this particular impulse. Therefore, there was no entry. But in this case, we can see there was a drop, another drop. And after those two drops, we had a point, which is this one. We had drop, break of the low, then a retest of the 50 EMA. There was a bearish engulfing pattern. Although the trade was not so much long, it could have ended as a break-even trade. So basically, that is what we will be looking for. You need to see a clear break of market structure from level 1 into level 2 for you to actually deem that a high probability point of entry when we go into level 3. Like always, we say, before you use a particular strategy, you need to backtest it and know the ins and outs of that particular strategy, how it performs before we apply it on a real account. So in this particular case, that is what we are talking about. And I actually have used this trading strategy for quite some time before I now focus more on the swing side. I now love to enter and leave the markets and let them run. On that note, we've come to the end of this video. Thank you for watching. Like and subscribe, and I'll see you in the next one.